It is such an exciting time in your life when you start earning a salary and can afford to leave home and find a place. So the decision you have to make is, do I buy or do I rent? A lot of times people think that renting is taboo because you're paying off somebody else's mortgage, but situation differs from person to person. So these are the things that I'd like you to consider before you buy or rent a property. The first thing you need to consider is how long you plan to live in the area. Remember, you just started working and might not afford the very expensive suburb where you want to live. So you need to consider, if you plan to live in the area for long, then you should consider buying. Whereas if you don't plan to stay in the area for long, then renting could be an option for you. The next thing you need to consider, which is the most important thing, is affordability. If you're renting, you can look at options like renting with somebody or staying alone. So situation differs from person to person, and in the start of your career you might not have enough money to buy a property. So renting might be the option that is available to you because of financial constraints. In the first few years of your career, you're still finding yourself whether you must stay in Joburg or stay in Cape Town. Therefore, renting might be a better option than buying a property. When you buy a property, you can't just walk away from a mortgage loan, which means that if you need to move to another area, you need to find a tenant who will need to pay off your mortgage. Whereas if you're renting, all you do is just give notice and walk away. So it makes life very easy for you. Buying comes with upfront costs that people normally don't tell you about. First of all, if you're buying from a developer, then you will not be paying any transfer cost. All you'll be liable for is the initial cost. If you're buying from another seller, then you might be liable for transfer cost, bond registration cost, and the initial cost. To add to that, you might be required to pay a deposit towards the house. Because as a first-time buyer, you might not have enough credit history, and lenders might require a deposit from you. Therefore, it is important that you're prepared for what you're getting yourself into. But this situation differs from person to person. The owner of the property will be liable for the ongoing cost of owning a property. Those costs include levies, if the property is in an estate, rates and taxes, and homeowners insurance. In addition to that, they are liable for the repairs and maintenance of the property. So if you are a tenant in that property and something is broken, all you do is call the landlord and they will sort it out. That is not a bill that you will expect at the end of the month. Most young people don't have the cash to buy a property. Therefore, they need to take out mortgage loan to finance this cost. If you are renting, all you do is sign the amount that you've signed up for on your lease. Whereas, as the property owner, you need to pay back the mortgage loan for a number of years that you select, sometimes 20 to 30. And it is important to understand that this cost is affected by the repo rate that is changed by the Reserve Bank. What that means is that if the repo rate is increased by 0.25%, then the monthly repayment will increase, which means that the cost of debt will increase. But if the repo rate reduces by 0.25, what that does is it reduces the cost of debts. So you as the tenant is not affected by the changes in repo rates or how it affects the owner of the property. So if you're the owner of the property and the repo rate goes down, my recommendation is to continue keeping the repayment at the same level as it was before the changes in the repo rate, so that you can reduce the term of your contract. The owner of the property is the only one that can do any renovations or any improvement to the property, which means that you as the tenant cannot do any renovations in that property. Most of the times, improvement will increase the value of the property, which means that when you sell the property, you might sell the property at a higher price than what you've paid for. The property that you buy can be used as an investment in the future. And what that means is that if your salary increases and you don't want to stay in the area, you can use the property as a rental property, which means you can earn passive income from the property. If you consider buying a property, that property can be used as an investment property in the future. By that, I mean that as your career progresses, so will the need to move from a certain area, which you feel you might not be suitable to stay in. And you might use that property as a rental property for other people who are looking to stay, which means that the tenant will be the one that will pay off your bond. That means that the value of your property will be financed by that tenant, and that will increase your investment portfolio. In conclusion, the decision to buy or rent is very personal, and it differs from person to person. If your intention is short-term, then you should consider renting. But if your decision is more long-term and you'd like to own the property as an investment property in the future, then buying is an option. This is not a decision that one can make in isolation. Therefore, you need to do your research and be very clear about what you're trying to achieve.